We are in a very interesting time. The market is volatile. So even though the stock market is still high, there's still a lot of volatility out there, especially in the private markets. And the companies are getting funded, which is we really love to see. But there is a lot more scrutinizing around the different deals that we're seeing and how investors are really looking at these opportunities. So today I'm going to go through a little overview of the Keiretsu Forum organization. I'm going to go through some of what I feel is what makes up an ideal pitch for how an investor thinks, and then some COVID tips near the end, and we should conclude in about an hour, and then I'll open it up for Q&A at the end of the session. If you do have questions that pop into your head, just feel free to put them into the chat window, and I will answer them at the end of the meeting, and we can go through that. So who am I and why do I lead this training? So I'm Brianna McDonald, and I am the president for Keiretsu Forum Northwest. I have been participating in Keiretsu Forum for 15 years and have been investing in companies that long as well. And so I created this presentation training because I just got so tired of listening to pitches that the companies couldn't articulate their value proposition. I couldn't figure out what they were, what they did, why they were standing in front of me, and where they were going to go. And so basically off of 15 years of listening to some really awful pitches, I've created this presentation training. And so this presentation training is more focused on content and psychology than it is on storytelling and making things fun and fruity. So it's more content heavy as to that is what I'm actually looking for as an investor when I am listening to a company pitch. So who is Keiretsu Forum and what do we do? So we are the largest, most active investment group in the world. And so we were founded in 2000. We have funded over 1,000 companies to date. We have over 3,000 members on 50 chapters plus on 3 continents. So we have been doing this a long time, and we've been leaders in the work that we have done. So we typically fund this gap that is between seed, startup, and really that growth capital. Although I will say we have, due to family offices and the way we've been able to build out our family office membership, we have extended into those later stage funding. So we're typically funding rounds between 500,000, which would be in a form of a note or a bridge, up to 5 million capital raised. We will look at portfolio companies in B and C rounds that are raising up to 10 million and help to fund them. We work through investment groups. We syndicate our deal flow. The one thing that I find really interesting, and I don't know, I keep checking back to the Center of Venture Research. They have not updated their stats for 2019 as of yet. So I still have the 2018 stats, but this is really interesting to look at. And so as we've been able to go through 15 years of investing, it's changed dramatically. What was Series A is now Series B. What, now it was, Series A is now seed funding from what we used to see it as. And so there has been over 66,000 deals that were funded, about 23 billion into this early stage sector. Stark comparison is the VC route is just under 9,000 deals, 130 billion. So you see a tremendous amount of capital going into that VC sector, but very few companies. And so private investors tend to go a different direction than VCs. And so we really don't play in the same sandbox together all that often. And so it's up to the company to really figure out what track they're on and what they want to go for. There's pros and cons to each of the different routes that you could potentially take as you go out there and seek funding. So we've been #1 actually the last 4 years running in early stage investments. Last year was no different. We are, up there with many other reputable organizations, Alumni Venture Group, Y Combinator, 500 Startups. But one thing that did occur last year too is that we became #1 in late stage funding as well. So really looking at those B and C rounds, our investors are willing to take the risk on those later stage rounds, especially for portfolio companies. The companies are a little bit more baked. There's a little bit more due diligence that we're able to do. Even though the valuations are high, the hope is that the turnaround for exit will be shorter. Globally is no different. We came in #2 globally under early stage, just under 500 startups, but once again, #1 in that late stage funding. So we're a very active investment group. We have a very active base of investors who are funding deals every month, which is fantastic. And here in the Pacific Northwest, we did about 54 million in funding. 83 out of the 102 companies were funded. As you can see, it's primarily technology and life science, but we do branch into some other sectors as well. So 80% of our companies have received funding the last couple of years. This year is also no different. I believe our numbers are about 75% for the companies that have come through our process have received funding, with 20.6 million being funded to date for Q1 and Q2 that we've been tracking. So even though we might see a little downturn due to the COVID pandemic and everything that's going on, our funding numbers, I believe, are still going to be strong for 2020, ranging between 40 and 50 million. All right, so a little bit about our investment process for those entrepreneurs signing on for the first time. There is a strict process that the companies have to move through in order to be able to get to that funding stage. So typically it starts out with committee review. I also have Amber Cannon on here. Amber is the Deputy Entrepreneur Director. And so Amber helps to with the funnel at the beginning. So you're typically communicating with her and getting the information that you need about the different screenings, about committees, and what's happening. So we do have 2 very active committees between technology and life science, because that is predominantly what we fund. And then we have other committees set up for companies in the other sectors when those companies present themselves. So it is under member review. We have deal screening happening next week. So we'll be looking at, between 7 and 10 opportunities at deal screening. Our members choose who goes on to the next stage or not. So they will be grading you on 10 different metric points and inviting, delaying, or passing on your opportunity, and then we'll provide resources of other potential investment groups that might be a better fit for the type of company that you're looking to fund. Our forum meetings happen every month. We go on the road now to 6 different meetings. We're putting our companies still in front of about 300 investors, and then from there, a few of those companies will break out and work into due diligence, which is now led by Nate Foose, and he is our director. He herds all the cats with the investors. The investors do the work. They provide the work, and at the end, typically it's best for you to come back through with an update, show off your due diligence report, show off your funding you've received to date, and close the rest of your round. All right, so let's get into the heart of it. So creating a fundable pitch. And I'm going to tell you right now that your pitch isn't actually what makes you fundable. Your pitch is all about doing one thing, which is generating interest. So when I started a company many moons ago, I had to go out and raise $1 million, and it was daunting. I thought about that $1 million all the time. I needed that cash. I needed that money to really get to the next stage. But at the end of the day, we're running a marathon as entrepreneurs. And so if you're really able to break that down into smaller bites that you can chew off, those achievable goals, if all you need to do is get into a meeting and generate interest with 5 investors, I want 5 callbacks from these investors, that's a much more achievable goal than saying, I need to go into this pitch and raise $1 million. Okay, people invest in people they know and trust. Your pitch is just the beginning and that starting point for what you're able to do. So it's about building relationships. It's about getting to know people. It's about demonstrating competency as a CEO and why you're the company to fund and why this investor is going to see an ROI at the end of the day. So a few things that need to be translated in your pitch is one, and first and foremost, is your purpose. This could also be translated with your passion. So this is the gasoline. This is what keeps you up late at night. This is what gets you up early in the morning. This is what keeps you running that hard marathon day in and day out to achieve your goals. This comes through in different ways. This does not necessarily come through in the words that you speak, but more the inflection in the tone in your voice, your passion surrounding the problem you're solving, and the solution that you've created. That's really going to make this the next greatest thing. And so please keep that in mind, that language is a very small portion of what we are conveying in our pitch. Even on Zoom, there are ways to be able to convey your passion and your purpose for creating this company and this opportunity that translates to investors in other ways that, that words just cannot. Eliminate red flags. So it is of the entrepreneur mindset that you have got to have the most perfect polished pitch as you go into things. As an investor, especially in early stage companies, I know that your company is not fully baked, that there are problems that are going to be had, that the road is long. And I need to know that you understand what those red flags are. When you're asked a question, it does not need to be the perfect answer. If you need to do more research, say that. But giving an investor the opportunity to give you gotcha questions is not what you want. Call out the elephant in the room, eliminate those red flags and confusion, understand that we know that there are things that you need help with. And that's okay. That's why you're pitching to angel investors. We're here to help. We want to put our capital in. We want to put our time in. We want to put our resources in. We want to make those connections. So you need to eliminate those red flags and confusion, because those are the two things that investors are looking for while you pitch. And so if you come off as knowing it all and having all the answers, that's typically not a great starting point for raising capital, and you will be dismissed. So keep that in mind. Also, those gotcha questions are never fun to get when you're put on the spot. Next is competency. You need to demonstrate competency. You are the person to be in this role and leading this company. In addition, you have a team around you that you have built that also helps to lead this company. So you need to be able to show that you're the person to do this.
But I'm not. I don't have to.
Can you please mute yourself if you're not muted? Thank you. So I need to know, at the end of the day, if you cannot execute upon this plan, my investment still goes to zero. So competency is important. Never delete a slide. Always throw things in the appendix. Use your deck during Q&A. Q&A is the portion where you demonstrate that competency, and you're able to show the investors that you have researched, you understand, you know. And so use that deck as you go through. Yes, you can keep it up on the last slide, the thank you slide with the information and the advertising on it, but also feel free to do that. The Q&A is also a portion of your pitch. And then last, if you're able to do those four things, typically you're able to raise capital. And that is what the end goal is. And so being able to raise that capital and getting back to what you do best, which is growing your company. Raising capital is a full-time job. And most entrepreneurs, don't like working 2 full-time jobs, because they're already probably working 2 or 3 other full-time jobs because they're, bootstrapping it and making things happen here. So it's great to be able to take one of those off your plate. So the sooner you can raise capital and the sooner you can prepare, the sooner you can get back to doing what you do best. All right, so I have a kind of a generic slide deck order, and granted, there's a lot of gray area that can be had here. And so if you're pitching a deal screening, you have 7 minutes to pitch. And the last thing I want to hear is that's not enough time for me, because that's a bunch of BS. It's plenty of time for you to generate interest, which is the total goal. I don't need you to dive into the weeds on everything that's going on with your company, because if you start diving into the weeds too much, you start creating confusion and red flags, which then makes me, want to move on to the next deal. So typically we go from title slide, which is also the overview slide, the problem slide, the solution slide, which should take up a couple of slides, the market, this is the total addressable market, as well as your target market, go-to-market strategy, which is what we fund, so that typically needs a couple of slides, barriers to entry, competition, financials, team, deal, exit, traction, and closing. So that might seem like a lot to fit in, but it's actually not. And you're able to really hit on those high points and create that interest to get those questions asked, to engage the investors, to demonstrate competency. So this is really built in a special way that is meant to keep the investor focused. So one thing I discovered early on was I start to wander in my mind. And so we can thank Apple for this. We kind of have the ability to multitask, but typically when we multitask, one thing tends to not go so well. we do not have the ability to multifocus. This is why we can't text and drive at the same time. This is why we can't have two conversations at the same time. So trying to create a fun and fancy deck that, you know, adds a punch at the end or whatever it is, it really doesn't work for me. It ends up just creating more confusion. And so psychologically, I am used to seeing things in a certain format. And because of that format, if the slides don't come in the order that I'm used to hearing the story, I start problem solving in my mind. And the minute I start problem solving in my mind, what is going on with your company, I am done listening to you talk, because I do not have the capacity to think and listen at the same time. Same thing goes with reading your slides. So if you have lots of words on your slides, please rethink that. You can choose if you want me to read your deck or if you want me to listen to you pitch. So I'm only going to do one or the other. There's definitely two different types of decks that you can have out there. One is for, you know, sending to investors that they're able to read and digest the information. Another is for pitching. You need a couple of different decks that you're using. So please keep that in mind. But I see this as a great building of a story. Also, this deck is set up this way because the most important things are at the end. We can also thank Apple because we have the attention span of gnats. We forget things. And so what we hear last is what we typically remember. The problem, I don't give a crap about the problem. That's why it's at the beginning. You know, I just want to know that there is a problem, you know, but I want to get into what the deal is, what the exit is, what the opportunity is, what the traction is. These are the things that I'm going to be listening to right before I fill out my interest sheet. And so, and this is where entrepreneurs typically get hung up, because that number 2 slide is where they spend a majority of their time and energy, and then they rush through the end of the deck. How many times have you seen a company pitch where it's like, oh, this is my team, it's great, pass, I'm getting to my deal. Oh, I need to get through this. Oh, this is the deal slide. Oh, and then I end. You know, it's like, don't do that. Your team is everything. So keep this in mind as you go through. There is gray, but there is plenty of time for you to be able to touch on the high points of what is going on with your company as you pitch your deal, no matter how many minutes you have. All right, so the first slide. The title slide, or what I like to call the overview slide. So this slide lays the foundation of everything that I'm about to listen to. So as an investor, I need to know a couple of things. I need to know who you are and why you're standing in front of me, what's your title, the name of your company, a brief little statement on what your company does, and why you're here. And that's it. Then I don't have to ask any questions. If you're a B2B SaaS company, great, just say that. I'm a B2B SaaS company, building the next, you know, business for enterprise. Great, whatever it is. I'm here raising $500,000 on a convertible note. I'm the CEO, or I'm not the CEO. I mean, sometimes the CEO isn't best to pitch, but if you're not the CEO should be present during the pitch regardless. Because the CEO is typically the one that raises the capital. And if the CEO can't raise the capital and is not good at pitching, they need to be present to answer questions. It gets a little funny business when the CEO is not there. So I have now had the foundation as an investor for who you are, what your business does, and why you're standing in front of me. I'm not going to be trying to think to myself, what is your company, as I'm going through the slides. All right, problem slide. Take in this slide. What do you feel when you look at this picture? So the problem slide is meant to invoke feeling. It's meant to hook me as an investor that I want to listen through the rest of the pitch. This is not, though, where you spend, you know, a majority of your time. This is where you spend maybe 30 seconds. I need to know that there is a problem that you're solving. This woman is frustrated after listening to horrible pitches for 15 years. She needs a solution to this problem. So, you know, what can you do? What types of pictures can you put in place to really bring about those pain points, to hook the investor and have them engage through the rest of your presentation and really listen to that solution? If you fill this slide with words, you're going to lose the investor right off the bat. Use big pictures, describe your problem, and then move on to what the most important thing is, which is what we're going to be funding, which is your solution. So what is your solution? What is it? Why is it better? Why are people going to choose it? Why is it better than the competition that's currently out there? What are you doing? Show pictures, show people engaging it, show happy faces. You know, this is where the psychology really plays in well too, right? Those big pictures, and you're able to explain why this, you know, this solution is the one to take it the distance. Now you're going to need to back that up with all the rest of the slides that follow. So please do keep that in mind. But take a couple of slides. This is where you want to spend some time, you know, spend a minute here, talk about that solution. Don't give me too much information. Give me just a high level amount of information so I'm able to really be able to digest and understand what it is your product is and what you're selling. Okay, so then we go into the addressable market slide. For me, this is a red flag slide. So I will automatically dismiss a company that is everything to everyone in the world. You have no idea how many times I've heard companies say that they are everything to everyone in the world. This product can be marketed to everybody. Well, that's fine and great. I want to know that the market is big. It needs to be able to scale and have that ability to really have that rapid growth, to be a venture-backed company. That said, I also need to understand what your target market is. So if you have a $2 trillion market, awesome, good for you. I want to see you starting at the $500 million level. I mean, where is that small segment that you as a small company can really bite it off and show me how you grow? This here ties directly for me with your financial slide. It shows me your ability to scale. And so I know that you have thought about how you grow this business. And so thinking about that, I typically like to see this in the form of a chart, some sort of a graph that is able to show me the entire addressable market and what that is, and then breaking it down into what that target market segment is. And then you take that little slice of the pie with that target market, and then you move into the go-to-market strategy. So you're taking that target market and then you're focusing on how you go there and how you grow your customers. Who's in your pipeline? What are your COGS? How far is your product from completion? Are you just in beta, or have you moved along? Is it actually out in the market? The market research, what it's shown, and then your sales strategy, how you're going to get there. This is a complex part of your presentation. It typically takes a couple of slides to be able to really demonstrate how you're attracting those customers, how you're generating revenue, and what you're doing. Now, if you're a life science company, this is a little bit of a different beast. If you're a life science company, your go-to-market is typically through clinical trials, the different testing that's being done, getting to the FDA and getting that FDA approval to then be able to get to your market. We typically don't fund a lot of R&D at Keiretsu Forum. We typically fund companies that are moving into clinical trials and working through that. So keep that in mind. But if you have partner hospitals that you're working with, if you have different organizations that are really helping you along that pathway, that's all a part of your go-to-market strategy and how you're going to really be able to bring it together. So from your go-to-market strategy, you just pulled out your target market and how you're going to do that. Now you're going to tell me on what's going to keep the others out. What are those barriers to entry? What makes you special? Do you have IP? IP isn't necessary. Trade secrets, I actually think, have a lot more weight than IP. IP is great for some types of companies, but then it gets published out there to the world on what you're doing, and then it really becomes a defensibility thing, right? So like thinking like, okay, well, I have 50 patents, but I'm going up against this big behemoth, and if they start infringing on my patents, do I actually have the capital to pursue lawsuits against them to make them stop? Because that's typically what happens, right? But having those protections in place, having those barriers to entry. If you're a consumer goods company, this is a little bit tougher. You can have design patents and things, but that doesn't really, there's workarounds. So it's more of a land grab. And so if it's a land grab opportunity too, that's fine. Just call it out and have it be what it is, right? You need to get to market fast. You need this capital fast to be able to do what you need to do. So, all right. So then we get into another one of my favorite slides. So when I was an entrepreneur, I had very little barriers to entry. I was creating a consumer goods company. It was going to be direct to consumer. And I was terrified of my competition, terrified. But I have come to learn over the years that competition is your friend. I mean, it really is. It helps you to differentiate yourself in the marketplace. They are trailblazers. They have taken that machete and they have built that trail for you to head down. So, understanding what they've done, looking and researching the mistakes that they've made, the things that haven't worked, is really important. They're also potential acquirers. So if your technology is differentiated just enough, they would want to, acquire your business, because we don't see a lot of R&D happening within companies these days. There is some entrepreneurship that does occur, but they're typically ready to buy your company and bring in that technology versus building it. And then also learning, from that competition. I am also a big believer in, spreading the love around a little bit. There is the ability to bring on advisors. There's the ability, and don't give them everything. Don't give them your trade secrets. But if you're able to befriend some of those individuals that are within your company or within the competitor's company, you have now tied them directly to the success of your business. And so when you win, they win. And so just a strategy to think about, that would be good. Excuse me for a second. All right. So from competition, you just have told me what the barriers are and who else is out there. Oh, just real quick, as I go back to competition, pictures, once again. So typically in a quadrant slide, I like to see this. Of course, you end up in the upper right-hand corner or maybe in the center. If you do choose to do a graph type formation, don't put yourself at the bottom. I mean, I can't tell you how many times I look at companies' decks and it's like they have their competition listed out and they're at the bottom. Like psychologically, you're at the bottom underneath all your competition. That's not really good placement for you. You want to put yourself at the top and then really look at adding in those green checks and those red X's. Colors, we do really identify with, and they have different triggers for humans in many different ways. And so how can you leverage that color to really be able to show how you stand out in a crowd? So things to keep in mind as you discuss your competition. Also, one other thing with your competition, you need to think about status quo. Status quo is your competition as well. There was one time I judged a business plan competition, and they had created this bracelet. In this bracelet, you could hide a key in. And so it was this novel concept, right? And I'm reading through this business plan and they have their competition and they listed out 3 different other bracelet makers that you could hide this key in. Well, I mean, I wrote back and I'm like, I don't know, what about a pocket? What about a purse? Why would someone buy this to put it in here when they can put their key in a pocket? I don't know. Think about that, because that's also a red flag opportunity for investors. If you haven't fully thought through the status quo and changing behavior is tough. So humans, as much as change is constant, and it's the one thing we should always be expecting day in and day out, it's the one thing we resist the most. So do keep that in mind as you think about your competition. All right, financial projections. All right, so this is where things start getting a little long and I have a lot to go into. Financial projections. I need to see a hockey stick. And it's funny, one time, many years ago, a company came in and they just put a hockey stick for their financial projections. And we all laughed and thought it was funny. But I will tell you, when the hockey stick isn't there, we get nervous. And the hockey stick really needs to tie back to that market and your target market, and then how you methodically grow to get to those numbers. Now, as you are calculating this and you keep going through your numbers, I don't need you to inflate your numbers. I mean, we understand that these are all projections, right? But not every company is actually meant to go raise capital from investors. And so if you keep coming up with your numbers and they're consistently flat, and they're just flat, right? And it's well, maybe I could tweak this number here or tweak that number there, but it's kind of flat. I really think you should reconsider how you are going about to raise capital. There's lots of different opportunities and funding opportunities out there for entrepreneurs in different types of businesses. There's lots of small and medium-sized businesses that are just meant to be that, right? And so if you can't see that inflection, that growth that's going to be able to attract an acquirer, I would really go back to the drawing board and think long and hard about what you're doing. So think about those metrics, know them inside and out. Understand your capitalization plan and how these fit in with your numbers, the different fundings that need to come at different stages that get you to exit. If you don't understand your capitalization plan and how you work from the end to the beginning, once again, I don't think you should be raising capital. I think that you really need to go to the drawing board and understand what those numbers could be that you need to raise in total and what that looks like for you to go the distance. So like I said, I need to understand how the funds get used in different ways, the different inflection points, see that hockey stick growth, and then provide me real numbers. This is where I hear 90% of our entrepreneurs say they have conservative financial projections. Okay, you want to annoy the crap out of me? Use the word conservative. I just want the real numbers. Is it 1%? Is it 3%? Is it 5%? What is it of the market that you're actually doing? Adding in these weasel words, conservative, that tells me absolutely nothing. I know nothing about your numbers. I know nothing about how you pared them down. And that comes with really any adjectives that go into your pitch or come into your due diligence report later. Just give me statements on what you're doing and how it works and how much it is, so then I know as the investor what to take into account. So that is just fingernails on the chalkboard for me there. And sorry, I got a little heated in my passion on hating that word used along with financial projections. So then we have the team, and the team comes next because the team is the one that's executing upon the numbers. And so once again, each slide flows into the next slide. So this is everything. Do not skip over this slide, as I said at the beginning. You are all executing against this endeavor and hopefully going to help generate an ROI for me, the investor. So who are you? Why are you on the team? What experience do you bring to the table? Who have you surrounded yourself with? If you are an experienced CEO, fantastic. Great. Talk about that. Talk about the other individuals on your team who might be experienced in this space. If this is your first time out and this is your first rodeo, that's fine too. Just know that we need to know who is your board of advisors, who is on your board of directors. Who are you surrounding yourself with that has been there, done this before? Because this is hard work. And if you just come from Microsoft or Amazon and you think that you're going to go out and start a company, it is the school of hard knocks. It is a totally different beast from going from cushy corporate life to starting your own business. So something to keep in mind. It's just, you can come from all of that, but you need to have those people who are in your corner that you can call on to be able to help support you in this effort. Two people who are not your advisors are your attorney and your CPA, okay? These individuals, whereas they are really great in a lot of different ways. They're good. They offer different resources. They can be helpful. They are inherently trained to be risk adverse. They are inherently trained to do the opposite of what you are doing. So just something to keep in mind. They are there to support you and be there for you. They also cost a lot of money. So find those serial entrepreneurs, bring them on board. Those are the individuals that should be helping you along the way. Board of directors, the difference between the board of advisors and the board of directors, just in case you don't know, the advisors are there to support the CEO and support the business. They're there to help with the growth strategy and the things going on. They're there that you can call on them and ask them questions, and they can help support you. The board of directors has a fiduciary responsibility to investors. So this is extremely important for us, the investors, to know that this is being set up and exists. Now, granted, with some earlier stage companies, this is a little bit more This is a little bit newer. There's not a lot of fiduciary needs that are needed, but we need to understand the growth plan for the board of directors. Brad Feld has written a book called Startup Boards. It's a great introductory book to creating a board of directors and how you go about doing that. I would recommend reading that, but it's really important. And so being able to keep track of your minutes, I know certain investors that we have within our organization, they ask for your minutes of your board of directors meetings. So, you know, how regularly are you meeting? Are you meeting on a quarterly basis? What does that look like? But this team is really important. Sometimes you don't have the time to go into all the advisors and the directors that are supporting you. If you don't have that time, just throw those slides in your appendix. Have those ready and waiting in the wings so you can pull upon them when it comes to that Q&A portion of your pitch. But I will restate this one more time. Do not skip over this slide. At the end of the day, I'm writing a check because I believe in you. And I believe in your ability to execute upon this deal. And so I need to understand the team fully. And then we get to the deal. So we're investing in the team, which is why the deal comes next, right? So a few things about the deal, and there's a lot to unpack here. So first off, is all your paperwork done? And do you actually know what's in your paperwork? Do you know what your attorney has drafted up for you? Do you know the implications of what it means for you and the contracts that your investor's about to sign, and what it means for your investors and what they're about to sign? Do you understand that fully? And I will say 95% of the time, most entrepreneurs don't. So be ready and prepared. This is a marriage that you're about to enter in that's really long-term. And as much as you're going to say at the end of the day, and I'll get to the exit slide next, you're going to say it's 3 to 5 years. Let's be realistic. It's really 7 to 10. So you need to really understand what it's going to be before you get connected to these individuals. What are your deal terms and why are they that way? So let's talk about deal terms for a moment. So in my previous life before kids, I sold real estate. And in selling real estate, I never thought I would use real estate to describe venture capital, but I actually do when it comes to deals. So there's a few different vehicles that can be used that entrepreneurs choose. And typically entrepreneurs choose what their attorney says. And their attorney is there to represent them. It's not there to represent the investor. And what we're looking for is we're looking for balance. We want the entrepreneurs to be taken care of, but we also want to make sure that we're being taken care of. So like I said, it's a marriage. And so you need to be able to have compromise amongst the two different parties. So we're going to describe this in a few different ways. Equity. So there's equity raises. This paperwork tends to be pretty expensive. Which is why entrepreneurs really need to plan accordingly. And they typically go out for a larger sum of money when they're doing an equity-based round. They typically have a lead investor that helps to set the valuation and get things moving along. I think seed equity right now is a little bit cheaper than Series A or B or C equity documents, but this is what I call buying a house. So when you buy a house, you're more secure in your investment in real estate, because not only do you have the house that you're buying, you have the land that's underneath the house. So equity is very much the same. You are tying me, the investor, directly into the success of your business. I am being tied to it by equity. This is typically the preferred deal terms that investors like. They want to be all in. They want to be tied to it. So you're more secure and safe in your investment when you buy a house. Now, the next vehicle that we see quite a bit of, it's cheaper to do, is convertible notes. Convertible notes typically have interest that's being paid over the period of time. There's a maturation date. Please include a cap. Investors, if they're any sort of professional investor and smart in any way, they will not invest in a note without a cap. on it, of what it would go into. And then there's a discount that goes into the equity financing round that will follow. In traditional terms, convertible notes have been typically used as bridges. So you did an equity raise, and then, you know, you're running a little tight on cash. You have a few more milestones you're like almost going to hit to get you to that next inflection point, right? And so you go out and you raise 500 or $1 million on a convertible note to really get you that distance and get you to that equity raise. Now, nowadays, we're just seeing it as really common that, well, it's really cheap for me to drop convertible note paperwork, so I'm just going to raise like note upon note upon note upon note upon note. And that's highly problematic. Calculating your waterfall and how much equity you have and then the debt load on the company can be really troublesome to the company down the road. So you need to think about that, and you need to work through and calculate your cap table and your waterfall and how that's all affected. Convertible notes are more preferred within the Keiretsu Forum organization. We like the fact that we like the fact that there's some interest and there's a discount in on the equity round with a maturation date, which is typically 18 to 24 months. And so we know it's going to convert to equity. It's in the paperwork. That said, convertible notes tend to be a dime a dozen. So there's all sorts of convertible note paperwork out there. Every law firm has its own different convertible notes. And so if you are having your law firm drop a convertible note, once again, it's really important for you to understand what those deal terms are. So convertible notes for me in real estate are like a condo. So it's a condo with a view, essentially. So you are buying air when you buy a condo. You don't have any land. If the market goes down, it's less secure than buying a house because you're buying a section of air and not actually land underneath it. But you have this view, and the view is really nice, and it helps to protect you and insulate you a bit with your investment and the investment you've made. So, and then the last deal term I'm going to talk about is safe note. So this is a simple agreement for future equity. This was developed by Y Combinator as a cheap, fast way for companies to raise capital, and it's all the rage in the Valley. We loathe safe notes. We think safe notes are completely lopsided to what an investor is putting in. They are writing their own hard-earned check to you to be able to invest in your company, and there's very little give on the other side. There's typically not a maturation date. There can be a cap, and it can be designed that way, but there is no interest. There might be a discount on the conversion into equity. There's no guarantee. So usually what triggers it to convert to equity is a certain amount of capital raise. So if you need to go out and raise $1 million to really convert that safe note, what happens if you go out and raise 750,000? You don't have to convert it. I am essentially investing in the promise that one day, maybe, if you're able to go to the distance, that I might get equity in this company. I call this the condo conversion on the first floor. Typically, it's the unit that's going to get broken into the most. When the market goes down, it is the unit that is going to lose the most amount of value right off the bat, and I'm going to lose my most amount of money investing in it. We can definitely go into a lot more information on safe notes and why we don't like them. I certainly understand in like the states of Colorado and then up in Canada, there are tax incentives for both equity and safe notes for the investors that invest in those opportunities. And so I definitely understand why they choose those. But here in Washington, we don't have that. So the investors tend to be a little bit more snarky when it comes to safe notes. And I will say in my conversations with other investment groups across the country, especially members of the ACA, I am not alone in this. So I understand what happens in the Valley is all the rage, but that doesn't necessarily mean reality for anything that's happening outside of the Valley. All right. Next, let's talk about your valuation and is it realistic? So this is what I call with real estate, overpricing your house. So, you know, you can look at a property online and it might be this gorgeous house in this amazing neighborhood. And you're looking at it and you're like, oh, it's been on the market for like 3 months. Like all the houses in this area have sold in a week. What's wrong with the house? There's something wrong with the house. Maybe it's the plumbing, maybe it's the foundation, maybe the neighbors are horrible. There's got to be something major wrong with this house. Well, chances are is the house is probably just fine, but the house was overpriced to begin with. And so because the house was overpriced to begin with, the house didn't sell. And so what ends up happening, the house ends up selling for substantially less than what the house was initially worth. I saw that happen time and time again in real estate. So things to keep in mind as you value your company. One, how long do you want to be raising capital? The market determines value, and we're your market. You are marketing your company to us to buy into it. So if you want to be out there raising capital forever, that's fine. You just don't get to go do what you do best, which is building your business. Overpriced companies tend not to bring in the funding. If they do end up bringing the funding and they bring in some dumb money, then what happens when the market turns or you don't hit your milestones? Then you get to do a down round. And those are loads of fun, to go back to your existing investor base and tell them why you're no longer worth what they put in at. So this is also the reason why you build out a capitalization table, to really understand how you meet those inflection points and those milestones and those different valuations at those different times, right? So thinking about that. If you want to raise capital quickly, you're going to price your company right. And how do you do that? That's usually the next, it's like this magic, that goes into like creating a valuation. And it kind of is. But once again, market determines value. So if you have an investor today that wants to write you a $500,000 check and is totally in support of your business, but you say you're worth 8 and they say you're worth 4, I don't know. At the end of the day, if you haven't brought in any other cash, are you just going to take the cash and go? This person is aligned with your values, everything that you're doing, and you're done, and you get to go back to doing what you do best. You really need to think about that. And a lot of the times, even just a couple of million in valuation, and when you look at the cap table and how it plans out in like percentage of ownership, is typically like, it's pennies really at the end of the day when you build it out and really look at your cap table. So think about that. This is not about ego. This is not about the fact that, oh, I have this like business I'm going to go out and create and I'm worth $10 million, but I have no revenue and I have no customers and I'm totally in beta tests and about to get maybe some LOIs signed. Awesome. Good luck with that. I've lost money doing that. And so that's a lot of what you're going to get. So you really need to think long and hard about what your valuation is and where it goes. And so, and I already talked about capitalization, but I mean, I could talk about the deal day in and day out. The biggest thing that you need to know is what are the pros for you and what are the pros for your investors in coming into this opportunity? How are you going to take care of them? Because they're helping to take care of you. So, it's a marriage. And you need to be complete about it. If there are resources beyond capital that you need on this slide, also list them here. So if you need to hire someone, if you need connections in someplace, go ahead and bring that in on this slide as well, because we're always happy to provide resources beyond capital. And sometimes from certain individuals, those resources can be more valuable than the capital itself. All right, exit. So I am not a charity. I don't just give out money. I am doing this. I am an investor. I do this to make money. I do this because I feel good. I like investing in companies. I like being able to fund the future and make the world a better place for my kids. I like being able to drive forward technology, but at the end of the day, I don't want it to just be a tax write-off. I want to make money. So I need to know what your exit strategy is from the beginning. And if you've built out your capitalization table, you're going to understand this. Understand the comps. What's going on in this space right now? Who's acquiring companies? Who could be those potential acquirers of you? If you're going to go IPO, it's a little bit riskier. There better be somebody on your team or on your board of advisors or in your board of directors that has actually conducted an IPO before. It is extremely complicated, and if you haven't prepared yourself from the get-go to go IPO, chances are is you will end up losing money for your investors if you go that route. So really think about that. And if you are choosing to go IPO and M&A, why the lack of focus? They're very different routes. And so when a company gets in front of me and says, I could go M&A or I could go IPO, typically that is a red flag for me that you actually haven't thought about your exit strategy and don't know what you're doing. So relationships are key. So going back to that competition, going back to those advisors, going back to all those people that you have met along the way. These are seeds that are being planted. They need to be watered. They need to be nurtured. Reach out every few months. But those relationships are key down the road, because typically when you are going to exit is just another stage of the company. And I think that this is a lot of times lost by entrepreneurs. So exit, just like R&D, just like ideation, just like growth, exit takes time. It typically takes 18 to 24 months to exit out of a company. And you need to start that exit process before you peak, which is really hard to do, right? Like, think about that. Like, okay, everything's going super great right now. Everything's going well, heads down, working, revenue's coming in. This is awesome. I love it. And all of a sudden you wake up one day and Google just bought your acquirer. Well, now shit. Now what do I do? Oh, now I got to go raise more capital, and I got to go figure out, and I got to create a new strategy, and I got to become relevant. And it's really the downhill climb that you start doing at that point. So once again, going to that plan, going to that capitalization table, going to those milestones you need to hit, and sticking to it, making adjustments as needed, but is really, really important to be able to deliver an ROI for your investors and an ROI for yourself. I mean, why are you going out and working so hard on this? So keep that in mind. Like, what do you want to do next? If you choose that, you know what, this is what I want to do forever, and I love this, and I'm happy, and this is great, great. Divest your investors, give them back their money, you know, plus, you know, return, and then go about your merry way. But, you know, they helped you get to someplace. So, you know, think about that and take care of them. Another board of advisors you can create that we've seen be very effective is an exit board of advisors, because exit is tough. Bringing in those M&A folks that you maybe have built relationships along the way, and you leverage them to make sure that you are in the right position to exit your company. You have, you know, the right amount of traction built up, and competition is really important, because typically if you get that phone call in the middle of the night, like, hey, I want to buy your company, and that sounds great, you're probably being lowballed and you're not getting what you're worth. So if you have one buyer, you have no buyer. So how do you drum up that competition to be able to get that bidding war to make yourself relevant? So like I said, this is another phase of a company, and it takes time. It doesn't just happen. And then after exit, we go ahead and what I call my traction slide, or the summary slide. And this is where you give to me all the high points, all the milestones you've hit to date, all the positive press and acknowledgments and awards and all the things that you've accomplished, how many customers you have. This is the last thing I'm going to hear after hearing who you are, your deal, your exit. You're going to summarize again for me, because I've been engulfed in that, everything that you talked about at the front end of the deck, because I've forgotten it. I've been listening to the deal and wondering why your valuation's so high, and wondering why it's this, and wondering why it's that, and why you don't have an exit strategy, or whatever it is. I need to hear this one more time. You know, what are the positive things that you've done? It doesn't need to be long, but make it, you know, short and sweet. Add some, you know, logos and things. You know, once again, logos, pictures, those all draw in emotion for humans. I have brand awareness. So if you put up an Apple sign or a Microsoft logo, you know, that's going to do something for me as I'm looking through and how much traction you've got. And then you finish with your closing slide. So you reiterate the problem you're solving and why you're the best to do it. Please be sure to include your contact information. If you have some of those acknowledgments and those press, feel free to put those press acknowledgments back up here. Thank the investors for your time. And if you're coming through our actual forum process and you're building a due diligence team, this is where you would ask people to fill out their interest sheet and to fill out to be a part of your due diligence team. So that was a lot to take in. I am recording this, and Amber can send it off to individuals afterwards to review if you wish. Raising capital has become completely different. And it's not necessarily that you need to be a COVID company. I mean, that's really on trend right now, and like, you know, and the investors are getting tired with it. Like, I don't need you to be a COVID company. I just need you to have a plan of like how you're being impacted and what you're going to do. It's great if you're able to capitalize on it in some ways, but that's less important. to me right now, with what I've seen. And what is more important is your business survival plan. And so typically the survival happens from those that move quickly. They have taken the choice, they've taken the horse by the reins, and they have like turned a 180, and they're like, we need to do this and we need to do it now. You won't regret it. Moving quickly, moving slowly, you're going to get gobbled up and you're going to get crushed, and you'll probably end up failing. And just being fully honest with you. I mean, we're used to this happening. So move quickly, be innovative about how you generate revenue. Really think about how you can go out there and bring in revenue in different ways than how you were doing it before. Because how we went in to this pandemic and how we're coming out of this pandemic, we're going to be a completely different society, I believe, in how we engage with one another and how we work. You're going to find that the sales pipelines slow, and this says 12 months of cash on hand. Honestly, I don't foresee us going back to some sort of life as we knew it until 2022. And that sounds very pessimistic, but we just hit 6.1 million cases in the United States, and we've had 185,000 people die. So it's no joke. It will be affected, and I do believe next year is going to be a little bit of a tougher year. So start planning now on what you're able to do. See if you can get those happy customers to pay in advance, build those relationships, and then really understand that market determines value. And I've said that a few times, but it's really important because it does. Who's going to buy what, when, at what price? So cut your burn rates. This is where extra things that you've been doing no longer need to happen. And you might need to look at how you potentially variabilize some of your staff, and how you compensate them. If they're able to take equity for the time being, great. Make sure you look at the employment laws in your state and understand exactly what they are. If you're doing a certain amount of work, you might have to pay minimum wage, but being able to do more of an equity compensation, and then that work can be a great way to help extend the life of your cash. You can negotiate with your vendors and landlords. I mean, I don't know what the commercial real estate environment's really going to look like in the coming year, and if people are going to be going back to offices as normal, but that could be something to cut out if you're able to virtualize your team and build those systems to really be able to engage your team in a virtual type of environment. Once again, revenue. Without cash, you have no business. So how, is there non-dilutive funding sources that you can get? Is there SBIR funding or NIH funding? There is still, EDIL funding. So, really looking at those different sources of cash flow that you can bring in to keep the company going, and then go back to your initial and, your existing investors. Instead of actually going out and raising capital from new investors too, you can do that to bring in that other value and expertise and things that you need at the table, those connections. There's a lot of reasons why you would raise capital at this time. But if that's proving too difficult with where you're at and the walls that you're up against, then please, go to your existing investors, communicate with them. This is when companies start getting quiet, was when things start going wrong. And this is the time that you need to reach out the most, because we invested in you, because we believe in you. And this is where we need to know what's going on and how we can help. So, so please keep that in mind. Communication is gold during this period of time. And so, when I created this deck a couple months ago, funding was going to slow. And I think we've seen a little bit of funding slowing. I definitely think there's some sectors that have slowed more than others. So if you have a travel business right now, it's going to be tough to raise money. I mean, even retail businesses, it's going to be tough. It's going to be tough to go out there and raise capital. If you have a technology business though, or if you have a life science business, this is still getting a tremendous amount of funding. I do believe that this is the wave of the future and where we're going to be going. And a lot of what humans have been uncomfortable doing up until this point, and what COVID and this pandemic has forced us into and forced us to do, is helping us to make this transition to evolve as a society. So term sheets are being renegotiated. Valuations need to be realistic. I will tell you, companies are getting funded because valuations are realistic. If you have, you know, no revenue, no customers, no product, and you think you're worth 10 million bucks and you're raising on a safe note, best of luck to you. So, but one thing that we will see from this is we will see a falling out of a bunch of companies. So we will end up seeing more failures. I also think we'll see more exits with some of our opportunities, but I do believe we'll see more failures, and just the strongest will survive. And the ones that are able to adapt and move quickly and have what it takes and what it needs to go forward into the future are who will come out of it. So that is what I've got. And thank you all.